Good morning, everybody. Welcome to Windsor Brokers live daily market outlook for Monday, 21st of January 2013. We are at the beginning of the new week with some important releases basically being the main focus for this week. Today's start of today's policy meeting of Bank of Japan is number one, and then we have series of manufacturing and services PMIs with focus, of course, on manufacturing ones to be released during the week from across the Europe that basically are the main focus for this week. The Bank of Japan remains under pressure to take some bolder policy steps. That includes further quantitative easing and setting a 2% inflation target. The bank officials came under political pressure to pull the country out of deflation, and as said, Bank of Japan is expected to unveil a raft of policy steps, including a further quantitative easing, and as I mentioned, setting a 2% inflation target on its today's meeting that starts tomorrow, with the releases expected in early hours of our local time tomorrow. The yen remains quite weak against the US dollar, as the recent strong rally made the dollar gaining about 13% over the Japanese yen, and the fresh 2.5-year high has been posted last Friday at 90.25. Overall, the strong dollar and the weak the Japanese currency are directly affecting the economy of Japan, and of course more hawkish new government that took power recently is putting now more pressure for some stronger action to surpass current crisis that was triggered also by weak yen. The yen also hit fresh lows versus euro and the Aussie dollar. Currently, in today's overnights and the early morning moving action is seen as corrective, as the dollar yen slips below 90 psychological support, and with 89 still holding the downside for now. The other important thing is releases of manufacturing data. The prospect of stronger European manufacturing surveys and decisive monetary easing in Japan, as I said, these are the focuses. But according to the PMIs from Europe, it's still not yet time for any celebration. Basically, the index derived from polls of purchasing managers across the European Union shows some signals of recovering, and but is still likely to remain well below the 50 threshold that signals expansion. This is another quite negative signal for European economies, and then expected contraction in the UK Britain economy, with the fourth quarter figures released on Friday will be a reminder, as well as Germany agreement to 2013 will be a reminder that Europe has to dig itself out of a deep hole. As said, PMIs that are due to be released are still expected to stay below the important 50 level that separates contraction from growth. We will see the next 2 days are most of releases are due to come, and this will be basically a signal for further action of the European officials. Most likely the further weakening is seen likely, as if you remember last week, the comments from Jean-Claude Juncker, who said that the worst is behind us, and 2013 will show brief signals and light but signals of recovery, while the comments from the other official that came the day after said something quite opposite, saying that 2013 is going to be the one where the European Union is going to hit their bottom, and then expectations of mild recovery action expected not before the fourth quarter of 2013 and into 2014. That will signal some stronger recovery. From the markets, said yen corrects its recent rallies with fresh high posted last Friday at 90.25, still holding above psychological and static support at 89.00, keeping the overall bulls still in play despite some quite extended conditions on the larger picture chart. Well, of course, more of this we're going to see on our technical part in a couple of minutes. The euro recovered some ground after last Friday's fall to 132.80, and now the main question among the analysts and investors is whether this is a peak that will not be cleared at 134.00. Of course, with the more negative tone seen on a break below 133 and 132.80, and the more significant 132.55 that marks the recent range floor, that will be signal for a double top and a stronger bearish action, or the single currency will remain on its positive near-term tone and see another attempt at 134.00 that so far proves to be quite a tough barrier. If we remember approximately less than a month ago, there was a similar situation at 133 psychological barrier where several attempts failed until the pair found the ground and finally broke above 133. Now we are facing the same situation at 134.00. Of course, a lot will depend now on fundamentals. As most of investors are awaiting the release of manufacturing PMI data during the week. The cable remains under heavy pressure, and the loss of last week's loss of important 160 support triggered fresh weakness below 159. That was our initial target, and the 200 days moving average with 158.40 seen so far, and the immediate focus is at 158.26. This is a low of 15th of November 2012, with the pair breaking below the main bull trend line, and now, main bear trend line. We have a lot of typing mistakes here. A main bear trend line that signals, or if I'm wrong, I do apologize if I'm wrong. I don't have chart in front of me, but I assume that it's correct. It's a main bull trend line. That sees prospect for a further weakness of the cable as break below 158.26. That marks the recent low of 15th of November, and the recent range floor would be confirmation of double top at 163 zone with spike higher at 163.80 seen at the beginning of the year. Will be trigger for a further weakness from the commodities. In energies and commodities remains steady. Gold is still holding above 1684 support that marks the previous high, with the near-term focus still seen towards the upper barriers. We have the last week's fresh high that was at 1697 and 1700 as psychological support, and then we have some Fibonacci expansion levels at 1706 that are basically our next upside targets, as the overall outlook remains still positive for the yellow metal. And that's all from the news and the technicals. We're going to take a look at a brief look at the calendar. US is closed today due to Martin Luther King holiday. Some releases seen from European countries. We already have the right move HPI from UK released at midnight at 0.2%, beating the previous negative minus 3.3% release. Producer price index from Germany again dipped below the last month's release of minus 0.1%. It came at minus 0.3%. And the industrial production from Switzerland, I don't have currently the release, but that's basically all except the wholesale sales due at 1330 from Canada that are forecasted below the previous month, 0.9% release at 0.4%. Quite a light calendar today due to holiday in the United States, and most likely some thinner market conditions and the higher and the lower volumes, could be seen in the second part of the day when America is due to start, as absence of the biggest world market will of course affect the markets in the afternoon trading. And finally, the technicals for today, we will as always start with the single currency. Just wait for you to see the screen. Okay, hourly chart still maintains a negative tone as the pair slid from a recent high at 134, 133.97 seen last week, 18th of January. Fresh dip down to 132.79. Keeps the threat at the lower boundary of the recent range at 132.55. We have it better, I think, on the 4-hour chart. Let me just change it this way. Okay, basically on the larger picture we are still in the range, trading with the upside being well protected at 134.00 and downside still holding by ascending 55 days exponential moving average. Initially 132.55 seen on 16th of January and the last Friday's low at 132.79 with quick recovery up to above levels above 133.00. Still struggling here. More congestion is seen now under 133. 30 recent highs posted overnight with the descending hourly 55 days exponential moving average so far limiting the upside. Basically we need to see the break above 133.30 and the 133.50 that marks 61.8% retracement in order to shift the near-term focus towards the upper boundaries of the recent range and the recent peaks and psychological barrier at 134.00. Otherwise, the downside will remain vulnerable as hourly studies are still negative and weak, and a failure to sustain breaks above 133 and eventually clear 133.30 as initial barrier would keep risk at the downside with immediate supports at 133.00, which is the intraday low of last Friday and last Friday's low and the last week's 18th of January low at 132.79 ahead of more significant 132.55 that marks a recent range floor. The 4-hour structure is still weak, I would say, at this point, with descending indicators seeing again downside more vulnerable as 20 days exponential moving average so far limits the recovery action, and number of analysts see more increased risk towards the downside. Basically, the main risk will be loss of 132.55, close to which is also 38.2% Fibonacci retracement of the latest uplink from 129.96 to 134.02. That will signal the double top formation as shown on the 4-hour chart, and the open way for a further retracement and further weakness with the next significant support expected to come in focus seen at 132.00. That marks 50% retracement of the entire rally. Conversely, as we said, the break above 133.50 is expected to shift focus higher and for possible renewed attempt towards a very strong barrier at 134.00. From the other side, the sterling remains under heavy pressure, as we said in our introduction, with the fresh weakness seen last week down to 158.53 and overnight's gap lower opening that dipped so far to 158.42, putting immediate pressure on the recent low and the 4 months range floor at 158.26. This is low of 15th of November, and basically if you see on the 4-hour chart we are within the range from mid-September until now. On the upside, the barriers are approximately at 163 zone, while on the downside the support is at 158.26. Break of initial targets and psychological support, as well as 200 days moving average at 159. Has seen dip so far to 158.42 and sees immediate threat towards the downside. Important support at 158.26, loss of which would first of all signal the full retracement of 158.26 to 163.80 and signal an end of the range trading phase that will open a way for a fresh stretch lower, and the targets on the downside at this point will be seen 158.00, and then we have 138% extension of Fibonacci extension at 156.14. As said, more focus still seen towards the downside with the corrective action seen on overextended, oversold conditions on the 1 and 4-hour chart. As we can see, our RSI is already out of the oversold territory, pointing higher with the levels seen at 159.00 that the price is currently approaching as initial resistance, and then 160.00, which is the next significant previous strong support, now acting as resistance. And basically, I would say at this point the 160.00 should contain any stronger rallies in order to keep the immediate bearish structure in play for extension, fresh extension, attack and extension, possible extension below 158.26, our immediate target. For today, we can expect some corrective action set 159. Then we have descending 20 days exponential moving average at 159.52 and 160.00 as previous lows, and psychological support now acting as good resistance. The resistance is reinforced by descending 4-hour 55 days exponential moving average currently at 163, with also the Fibonacci levels 76.4% of the down leg from 160.38 to 158.42. That will be seen as a breakpoint. Break above 160 would avert immediate downside risk and allow for some stronger correction, but at this point, according to the negative technicals, more focus would be seen towards the downside, especially that daily indicators broke into the negative zone, and the Fibonacci studies, Ichimoku studies are firmly bearish now after the price broke below 160.12 daily Ichimoku cloud base, with the Tenkan Sen line now also below the cloud, and the price holding below both Tenkan and Kijun Sen moving averages. That signals bearish action ahead. Dollar yen is in the corrective action of last Friday's fresh high at 90.25, with the hourly structure now turning more negative following a dip as low as 89.41 so far. We lost initial support 89.66 previous high, with the pair still bulls being larger bulls bill still comfortable at these levels, despite dipping to here. We have an initial support at 89.29, which marks 38.2% retracement of the uplift from 87.78 to 90.23, and the next more significant, I would say, support is 50% retracement and psychological level at 89.00. Seen as ideal, at or above this level is seen as ideal reversal zone in case of any deeper reversal. Of course, a lot depends now on the decision of Bank of Japan that will release their decision early next morning during the Asian session, and this will give the fresh direction for the pair. Most likely expected action from Bank of Japan is to reduce the current pressure on the Japanese yen and to recover it from the fresh lows that have last time been seen at 2.5 years ago, while absence of any bolder action would keep again pressure at the upside. We have 90.23, the recent low, and on the upside next target is at 90.39, close to it. It's 76.4% retracement of the latest down leg for 2010 high at 94.97 down to 2011 low at 75.55. The pair is in quite a strong recovery mode for now, but quite extended conditions on the daily chart see some potential, though no significant corrective action seen in the latest 4 months rally from mid-September 2012, when the pair progressed significantly from a 79.06 low of 9th of November that reached so far at 90.23, with said no significant corrective action seen so far. We had mild pullbacks, and basically, as I said, 89.00 is seen, according to the current structure, is seen as ideal reversal point. Any break below 89 would threat our key support, that is 87.78 low of 16th of January, a break of which would be a signal for some stronger corrective action. 88.72 above this is the 88.75, pardon, is ascending 4-hour 55 days moving average that is still in the up mode, as well as 20 days one that so far contains dips of 90.23, and keeping the upside still in focus despite the overbought conditions seen on the 1 hour chart that already came out of the overbought zone, and now moving into the negative territory. That of course signals some stronger corrective action. As said, 89.30 and 89.00 seen as quite important supports. I would say break below 88 and 89 and 88.40, that's its previous peak, and the 76.4% would definitely sideline near-term bulls, and shift focus down towards our key support at 87.78. And finally, dollar Swiss is in the near-term consolidative mode, sideways movements of last week's fresh high at 93.87, with the bulls still being in play following the recent strong rally from a 91 base that peaked at 93.87, approaching a significant psychological support at 94.00, our initial target, and the 94.30 that marks 200 days moving average, and also the previous peaks. Overall picture on the daily remains firmly bullish, and sees potential for a possible attack and break above 94.00, although the near-term studies are now in the neutral, hourlies are in the neutral mode following the recent consolidation. That is also being supported at psychological 93.00 in the recent range floor that keeps the bulls in play for now. A more clear picture is seen on the 4-hour chart, where ascending 20 days exponential moving average still holds. The downside, the recent dips to 93.02 and the 93.17 are still holding above the 20 days exponential moving average, and holding above this level that also marks approximately 23.6% of the uplift from 91.09 to 93.87 sees more potential towards the upside. Immediate risk would be seen on the break below 93.00 and then 92.80, that marks 38.2%, reinforced by ascending 55 days exponential moving average currently at 92.70. That would sideline immediate bulls and allow for some stronger recovery. It's important that any stronger dips would stay above 92 zone. That is also approximately 61.8% retracement of the uplift from 91.09 to 93.87 in order to keep upside targets in focus. Otherwise, a loss of 92 would put bulls on hold and look for some lower levels to be tested. Now downside, we have very strong support and base at 91 and 90.80, and this may come in focus in case of break below reversal below 92.00. For now, as said, upside is still in the near-term focus, and we are still looking for test of 94.00 and then 94.30, our next upside targets, with 93 so far holding the downside, and the dips expected to hold somewhere above 92.78 in order to keep any stronger dips expected to hold above these levels in order to keep immediate bullish structure in play. And crude oil is in the sideways consolidative mode. The bulls have been sidelined at this point following last week's rally to 96.02 seen on 17th of January, with the consolidative range being established between 94.90 and approximately 95.65 ahead of 96.02 peak. More focus at this point on the near term is seen towards the downside, as our indicators are breaking below their midlines at this point, but 55 days exponential moving average is still holding the downside, though now moving sideways. That increases risk of possible break lower and allowing for some stronger corrective action of the latest uplift 93.09 to 96.02. This also marks 94.90 is also marks recent low, marks 38.2% Fibonacci retracement. I would say at this point reversal down to 94.50-60 zone that marks also the previous peaks would be seen as ideal reversal point for a fresh attack higher, as larger bulls are still firmly in play, as the pair as the price broke above our next target at 95.33, that marks Fibonacci 161.8% expansion of the outlook from 95.20, with the larger picture bulls being firmly in play despite entering the overbought territory. We are focusing on the upside levels at 96.79, our next target, 76.4% retracement of the larger 172 to 84.05 descent. And of course, in the near term, we can expect attack towards psychological and strong barrier at $100 per barrel. Good support has set that 92.64 previous range, and the larger picture should not be exceeded in order to keep immediate bullish structure of 84.05 and the higher low at 85.20 in play. This is we're talking about February contract that expires, by the way, expires tonight due to early closure of U.S. markets. Some early close of contract will be required, and I think you have already received through a platform the closing schedule for the crude oil February contracts, with March now becoming a front month. And finally, a quick look at the yellow metal that, as I said at the beginning, maintains positive tone, though the bulls have been sidelined on the 1 and 4 hour chart according to the ADX studies, but the overall positive tone still keeps the upside in main focus, as corrective reversal of last week's fresh high at 1697 was contained at 1680, approximately 1684, that marks the previous highs, and ascending 20 days exponential moving average on the 4 hour chart, keeping immediate focus at the upside. Studies indicators in the positive territory, though moving sideways at this point, keep more focused towards the upside. Initial support, a loss of initial support basically at 1684 would signal would be initial signal for some stronger corrective action, with the levels on the downside seen previous high at 1678. That is also close to 23.6% retracement of the uplift from 1625 to 1697. Dynamic support 1676, 55 days exponential moving average still in the ascending mode, and 1670, 38.2% retracement. At this point, any dip below 1666, this is a low of 17th of January and also peak of 9th of January, seen as a break point. This is between 38 and 50% retracement, would be seen as a negative element, and would further pressure the downside, while holding above initial 1684 still keeps the upside in focus. And we are looking for a break above 55 days moving average on the daily chart, currently at 1695. Recent peak of 17th of January at 1697. That will open 1700 as a psychological level, and our next upside target 1709 as 100% expansion of the wave from 1625, reinforced by descending bear trend line of 1795 peak of 2012. That is approximately there, approximately 1707. So basically we have quite stronger resistance zone at 1700, 1710. That is our initial upside target, break of which is to confirm the near-term base at 1625, and look for some stronger corrective action and stronger recovery, as the yellow metal is still in the, as shown on the daily chart, in the downtrend from 2012 peak at 1795. That so far dipped to 1625, signaling the strongest, so far the strongest corrective action, along with the reversal from 2011 peak at 1920, but strongest corrective action in past 10 years or so, with the 15, 25, 26 zone so far holding the downside with bounce higher. I would say at this point on the longer term we are still in the range trading, with the downside being supported by at 1526 and the upside approximately at $1,800 per ounce. This is, we are talking about a larger picture in the weekly chart. Near-term structure is back to it, as this is a near-term outlook, is still bullish, and we have immediate targets at 17.00 and then 17.09, and that will be all from my side for today's news and technicals. Please, any questions, any comments, you can submit them in written now, and I will be glad to answer. Okay, we have a question for Euro Yen. Let's take a quick look. I think it's quite similar situation to Euro Dollar, but let's take a look first on the daily and see. Remains in the strong uptrend, 120.70 seen so far, and on the weekly chart there we can see the strength of the recent rally that retraced approximately, I would say, nearly 90% of the larger 123.31 high of 2011 to 94.10 low of 2012 descent, with the strong gains accelerating after breaking above 111.42 peak of 2012, posted on when it was in March 2012. Again, more focusing towards the upside according to the ADX studies. Bulls remain firmly in play, with the current reversals seen as corrective. From the Ichimoku studies, bullish structure remains intact for now on the daily, while a reversal from 120.70 peak of last week, 18th of January, broke initial Tenkan-sen support at 119.88, so far dipping to 119 zone. This is seen as a initial support ahead of Kijun-sen support at 118.58. From the other technicals, Fibonacci levels seen at this point of the uplook, latest uplook, from 113.53 to 120.70, 23.6 been tested so far, to also 20 days exponential moving average. More significant is 118 zone, with marks 38.2% retracement, reinforced by 55 days exponential moving average. Appearance of MACD and RSI bearish divergence on the 4-hour chart sees increased risk for possible stronger corrective action, as we can see it clearly here, and RSI too. Signals some stronger possibility of stronger corrective action. That's at 118 seen as initial support, then 50% at approximately 117, while the key support is at 116.45. This is low of 16th of January, and it's close to 61.8% retracement, along with the 115.90, 116 2nd of January fresh peak, seen as a break point. Basically, if we lose 116, then near-term bulls will be put aside in favor of some stronger correction. Otherwise, ideal reversal point is still seen at approximately 118 zone in order to keep the immediate bullish structure in play, though the technicals at this point are not supportive for such a scenario, as hourly indicators are already in the negative territory, and so far retracing approximately over 38.2% of the latest uplook from 116.45 to 120.70, with the fresh descent and the price below all three moving averages, seeing a more focus towards the downside. In the near term, I would say further retracement seen towards 118.60, 50%, and 118.61.8%. More risk will be seen on the loss in the near term of the loss of 118. Any other question, please? Or no more for today? It seems no questions. Okay, in that case, we're going to conclude our session, as Arabic one will start in a couple of minutes. We have to give them some space in the net. I would like also to welcome, I see some new names in our among our regular visitors. I would like to welcome all of them, and I hope you will find it useful and will become more regular visitor of our live sessions. For all those that connected later, as always, you will be able to find this session recorded and placed shortly in the YouTube on our page called Windsor Brokers Forex. We are back tomorrow morning at the same time at 8:00 GMT, 10 o'clock local Cyprus time, with some more news I expect to be seen after release of Bank of Japan's policy decision, and definitely we'll see some more action in the markets tomorrow morning. Until then, wish you nice Monday, nice beginning of the week, and of course good and profitable trades. Good luck.